Hi guys, Kayong here from Alpha Play Chief Currency Strategist. Understand that I've been missing for some time in terms of publishing videos for you guys, in terms of both weekly analysis as well as educational series videos. It's been a pretty busy period for me as well as for Alpha Play, what we've been doing over here for the past months. But no worries, we'll be catching up, alright, and publishing more videos coming this week as well as next week. Alright, I have received some requests from some of the subscribers and viewers, right, that they would like to understand a little bit more in terms of the topic of risk management, right? And I feel that it's pretty apt, especially and it's very important, right, especially for traders like you and me, and it's very apt because of the recent Brexit news, right? I'm not sure if you guys are aware of that. But as a retail trader, alright, honestly, to my own personal opinion, I feel that as a retail trader, there's no way you have any edge in trading the Brexit. And if you did and you profited to it, alright, good for you. But for those who stuck to their plan, alright, and did not trade in such volatile times, right, as well as understand that there will be a liquidity crunch, right? Liquidity in the market is thin, and you stuck to your plan, not trading in market for last week. I also like to congratulate you, all right, for being disciplined as a trader, and that's something that is one of the very key important traits to become a very successful trader, right? And I feel that with that, with those risk events happening, definitely it's not going to end as of last week, all right? Brexit is going to continue. In the whole news and the sentiment itself will follow through next week, and I feel that it's very important to talk about risk management. And so this video itself, it wouldn't be a market analysis, alright, but it's really on the topic of risk management. And I'll break this topic down, right, in terms of risk management into two key components. The first one is talking about money management, alright, and the second component for risk management is actually how you manage your trade, which is what we call trade management. Right, so we categorize risk management, we split them into money management as well as trade management. And in this video, right, the first part we'll talk about money management, and I'll release another video on a later date talking about trade management. Okay, so for risk management, what I'll share with you, you can actually access some of the technical strategies that we have published on my channel, alright. Feel free to look up there. I wouldn't share with you how we analyze using the technical strategies in this video, but I'll just share with you using those strategies, how do we put our stop loss, alright, stops in place. And that's a little bit about money management, because the first thing that you want to do is to identify where you want to get out if your trade idea is invalidated. Alright, so I will show you two examples in this video itself. Alright, I'm using the Euro-Dollar daily time frame as one of the examples for our pattern strategies, and the second example I'm using the Pound Aussie as well on the daily time frame to share with you the structure trend-based strategy. Okay, so over here for Euro-Dollar, what we have, if I pull in my Fibonacci, what we have is not a potential one, but it's already a completed Gartley pattern, right? So you see from X to A to B, 61.8 retracement, that gives us a potential Gartley pattern. And with that, we want to measure, right, in terms of Gartley completion, right, you'll be at the 127 extension. That's how we trade it, all right? There are many ways different traders trade their pattern strategies, but how we do is for Gartley pattern, we usually take our entry at 127. Alright, so this is where we enter. Alright, so if I put in this to show you, this is where we enter, alright, at the 127. Alright, so for pattern strategy, the stop loss is pretty straightforward, because what we do is we simply put our stop loss, right, beyond our X point, right? So if it's a bullish pattern, right, it will be slightly below our X point, but if it's a bearish pattern, it'll be slightly above our X point. Okay, so the question then sometimes traders will ask, more experienced traders will ask, what is exactly the pip count in terms of below or above your X point? Right, so for us, we use a very mechanical and systematic way. Is that if we are trading on a 4-hour time frame, we give a 25 pips buffer. But if we are trading on a shorter time frame, for example on H1, right, on the hourly time frame, we use a 15 pips buffer. All right, but buffer, what we mean is, if I mean 25 pips below, all right, buffer, what I mean is at X, all right, your X level, your price is at 1.08, all right, 15. Let's mix the number easier. Let's say if X is 1.0815, what I mean by 25 pip buffer is I deduct it by 25 pip, all right, and I put my stops below it. Why is that the case? Is simply because this X point, all right, can still serve as a minor support level for this bullish pattern, all right, and I want to give some room for price to bounce along this support level. Should price really respect that level? I don't want to get stop out right on the dot and then price then retrace back up. Right, so that's how we determine for the pattern. All right, so for take profit, is also using Fibonacci. Right, so if I clear this off, how we do it is for pattern strategy. All right, our risk in terms of take profit. Okay, we'll pull from Fibonacci. We'll pull from the top to where we enter. All right, and the first take profit will be at the trade 2. Let me pull in that level. Right, the first take profit level will be at the 38.2 retracement, Fibonacci retracement level, and second take profit level will be at the 618. Alright, so for take profit, you can see that most, or I wouldn't say most, all of our trade that we take, all the risk to reward ratio must be more than 1:1. Alright, and all the strategies that we adopted, that we use, by nature itself, the risk to reward is really more than 1:1. Alright, so by doing this, alright, now we know that this is where we enter, this is where we put our stop. The next thing you want to do is you want to calculate in terms of peak count, right? Because that's the next part of risk management, right? Your money management. You need to know what is the proper lot size or trade size that you need to enter for this particular trade. Alright, so you first need to calculate what is the peak count in terms of between your entry to your stop loss. Alright, so trading view here helped me calculate it. It's about 175 pips. Alright, so what you need to do next is let me bring you to baby pips. Alright, baby pips calculator. Alright, so you just have to Google baby pips calculator. The first search result, position size calculator, that's where you need to click into it. Right, so just now we calculated that our stop loss in terms of pip count, alright, is 175 pips. The next thing you need to do is just simply key in all this information that require from you. Alright, so let's say you have a trading size of 10,000 USD, right, and you're risking 2% per trade, and your stop loss and pips just now we calculated is 175 pips. Alright, and the currency pair you're trading is euro dollar, and you click calculate, and this is what is automated for you. Right, so baby pips calculator will give you what is the standard lot that you can trade. In this case, it's 0, meaning you must trade less than a standard lot. Right, and then if you look down, mini lot and micro lot. Alright, one mini lot, for those who are not familiar, alright, it is actually equivalent to 0.1 lot. Alright, micro lot it will be 0.01, and if you see 11 micro lot, it simply means 0.11. Right, so that's how you can calculate your trade size. Right, so anything above 0.11, you'll be actually over trading. Alright, meaning you are risking more than your intended 2% risk. Right, so this is pretty important because I after communicating, and interacting with many traders, a lot of traders are not even aware of how to actually properly calculate their position size in terms of trading. Right, so this is pretty important to really calculate and be consistent in terms of all your loss. Alright, this is how we put our stop loss and how we calculate our position size. Okay, so let me walk you through the other example, which is the pound Aussie. Alright, so for the example of pound Aussie, I would like to walk you through the methodology that we use to trade trend. Right, and we call this the 1, 2, 3, 4 or the structure-based trading methodology. Right, so the first thing you want to do is you want to first identify that you have 4 points forming a trend, which means you have a higher high or higher low, or the other way, alright, the converse. So in this case, what we see is that we have one high, one low, a lower high, and a lower low has been formed. Right, so we have a 1, 2, 3, 4. Okay, I won't walk you through in depth as to how we analyze this strategy because we do have a video on YouTube as well. If you want to find out more about this strategy, do refer to it. I'll drop you the link below in this video as well. Right, but in terms of entry and where we put our stop loss, we use Fibonacci a lot. Right, so what we do is we pull from our third point to the fourth point. We now see a confluence of previous structure here with a 61.8 retracement level. Alright, so that's where we're gonna enter, looking for a short opportunity. Right, so for stop loss, how we use and put our stop loss for this trading methodology is that our stop loss will be put 1 fib level above. So if our entry is 618, we put our stop loss at 786. Alright, and I always put a buffer. Alright, very similar in terms of the pattern strategy that I shared with you earlier. So if it's a 4-hour time frame, I put a 25 pip buffer. If it's a shorter time frame, like the hourly time frame, I actually put a 15 pips buffer. Alright, so similarly, if I just drag roughly, alright, to put it above 25, alright, so our stop loss is here, and our take profit will be at the previous structure. Alright, so if you can see, the risk to reward is pretty awesome. Alright, for more conservative trader, you can put at the previous structure instead of the previous low. Alright, so there's some structure over here. You can see the risk to reward is still pretty awesome. Alright, but as mechanical as we get, alright, we always put it at the low, right, which is 2.5 risk to reward. Alright, so the next step, once you identify again, right, the process is the same. Once you identify that that's where you're going to put your stop loss, you need to calculate in terms of numbers of pips. Alright, of course, this pair is pretty volatile, so if you calculate this, alright, TradingView showing me that this is actually a 400 pip stop loss. Right, pound Aussie 400 pip stop loss. So next thing I do is go over to put baby pips position size calculator. Alright, I need to key in 400 pips, and of course I need to select the currency pair, which is pound Aussie. Alright, and because this time around I'm not trading against the US dollar, they require an additional information price for Aussie dollar. So you need to get the current price of the Aussie dollar, and that's pretty easy. Alright, just go over to any platform that you're using, find out the price for Aussie dollar. Alright, so in this case, the price of Aussie dollar right now is trading at 0.747. Alright, I just round up a little bit. It's trading at 0.747. So what I just need to do is I key in 0.747 and I click calculate. Right, and you can see that this is what is automated. Alright, it's calculated for you. Alright, and you can see standard lot 0, mini lot 0, and micro lot 6. Right, so what this means is that the maximum position or the maximum size that you can trade is actually 6 micro lots. Right, that's equivalent to 0.06 lots. Right, again, anything above 0.06 lot will be over trading. Right, meaning you're risking more than 2%, risking more than your intended risk that you want to put in for this trade. Alright, so that's basically the process of how you can calculate. Very simply calculate what is the position size that you can trade. Control in terms of your risk management, your money management. Alright, of course, this is not the most comprehensive way of doing money management. There are more in-depth stuff that involve in it, but this is the very first and basic step that you need to be aware of. Alright, because after interacting with many traders, really a lot of them are not aware of how to properly put their position size to trade. Alright, so I hope that this video gives you some insights into how you can calculate your position size properly, as well as some insights into how we put our stop loss, right, and where we put our stop loss. Alright, so in the next video, I'll share with you a little bit more about trade management, how we shift our stop loss to protect our capital as price goes in favor in our direction. And if you like to keep yourself updated, alright, do subscribe to our channel so that when we release a new video, you'll be also notified. Alright. Other than that, feel free to drop us any comment or feedback on any topic that you'd like us to discuss more with you. And for support, right, do like and share this video with all your fellow traders and friends. Alright, with that, trade according to your plan. I'll do up a video analysis soon again. to share with you more about the insights of next week after Brexit, and trade according to your plan. I'll talk to you soon.